Hello everyone. Movements overnight really highlight the crucial role that central banks play in the currency markets nowadays. There was a lot of divergence in the commodity currencies. The Australian dollar was the best performing G10 currency overnight, followed by the New Zealand dollar. While on the other hand, the Canadian dollar was the second worst performing one after the yen. Now the Canadian dollar is clearly being influenced in part by the US economy, where yesterday's disappointing June retail sales figure showed a gain that was short of market estimates. But also, the Bank of Canada meets tomorrow, and this is its first meeting under the new governor. But almost all economists expect their statement to remain unchanged. On the other hand, the RBA released the minutes of its 2nd of July meeting, which revealed that the board members thought the inflation outlook there was slightly higher because of the Australian dollar's recent drop. So that reduced the likelihood of a rate cut at next month's RBA meeting and caused the Australian dollar to jump. Now, personally, I think the rally in Aussie dollar is overdone, and speculators may want to take a look at going short at these levels, perhaps even going short on Aussie against Canada in expectation of some mean reversion there. To my mind, a China slowdown seems a lot more likely than a US slowdown at this point, so the Australian dollar seems more vulnerable to me than the Canadian dollar. And after yesterday's reversal, it may be a good entry point. As for the New Zealand dollar, Q2 inflation was less than expected, which suggests the Reserve Bank of New Zealand will be able to keep rates low for longer. Yet the New Zealand dollar, the Kiwi, still strengthened against the US dollar. I still like to sell Aussie Kiwi, as I believe the China slowdown will hit Australia more than New Zealand. Again, this uptick may be a good entry point opportunity. Meanwhile, the yen was the worst performing G10 currency in anticipation of further dovish comments in the minutes of the recent policy board meeting, which will be released tomorrow. For today, there's a lot of data coming out. UK producer prices and consumer prices will be closely watched, as the Bank of England Monetary Policy Committee says one of its two major concerns is, quote, the potential responsiveness of inflation expectations to continued above target inflation. So, any indication that inflation is indeed continuing above target will be seen as, which it no doubt will be seen as discouraging further quantitative easing, and therefore is likely to be positive for sterling. Today's data, unfortunately, are expected to give a mixed picture, though. The month-on-month changes are under control, but the year-on-year rate of increases are accelerating. Now, we also have the German ZEW survey for July out today. It's forecast to show some improvement in the picture in Germany, which would be surprising to me, given the slowdown in factory orders and the decline in exports. I think optimism in the face of these data would likely to be euro positive, at least temporarily. In the US, again, we've got the CPI out. So the CPI is expected to be up 0.3% month on month in June. That's an acceleration from plus 0.1% in May. That acceleration should help to calm any fears among FOMC members that inflation is too low, and hence help to smooth the way ever so slightly for tapering off quantitative easing. That would be dollar positive. U.S. industrial production for June is forecast to be up 0.3% month on month, an acceleration from unchanged IP in May. And meanwhile, Eurozone IP for May was down 0.3% month on month, and UK IP was flat. So the U.S. figure would once again demonstrate the resilience and strength of the U.S. economy in comparison with these other economies, which should be bullish for the dollar. Finally, the National Association of Home Builders Index for July is forecast to fall back a bit to 51 from 52. But that's still above 50, meaning more respondents said conditions were good than said they were bad. Last month's figure was a 7-year high and the biggest monthly jump since 2002, so a small decline isn't surprising. Sustained confidence among home builders in the face of surging mortgage rates, which are up 120 basis points from the lows last November, will help to give Mr. Bernanke and company confidence that they can taper off quantitative easing without tapering off the housing market too. So net, today's U.S. indicators should be dollar bullish, and I'd expect the dollar to finish the day higher against most currencies. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.